Good morning. Good morning again. First of all, thank you very much for being with us today. We know that it's in the middle of August. It's not the best date considering the summer period. That's why we would like to start today by thanking you for being here. Today, what we have in mind is to organize this public webinar to walk you through the public consultation of the ENTSO review. This ENTSO review has been started pretty some time ago, has been triggered by the Clean Energy Packet in 2019. So it has been a long process for us to be here. And now we are conducting the phase of the public consultation. This public consultation, maybe just to start with some dates, is going to last till the 4th of September. And we wish to present you here some more insights, mainly about the two studies that are going to be consulted. This public consultation is a legal requirement according to the CACM and to the ENTSO review methodology. So maybe just before we go a bit further into the details, we wanted to also start by saying that we are bound by the requirements defined in the methodology and the legal requirements in the regulation regarding this public consultation. Having said that, I wish to share with you the agenda that we have planned for today. The idea is that this workshop is going to last till 1 p.m. of today. We will start by doing this very short introduction and explaining some technicalities about the process and how do we want to run this webinar. And after, we will continue with our colleagues from Compass Lexicon presenting two studies. The first of it is the study on the market liquidity and transaction cost. It will be around 40 minutes of presentation, and after we will leave around 20 minutes for questions and answers. And after the second study, also led by our colleagues from Compass Lexicon on transition costs, around 40 minutes of presentation and again around 20 minutes for questions and answers. The next phase, it will be around half an hour. This part will be led by Marijin, our colleague from TENET, who is going to present the public consultation, the process, and in general, any question or answer that you may have regarding this part. These are mainly the three parts that our public webinar will hold by today. And maybe if we move to the next slide, I can shortly walk you through the main technicalities that we will have in this webinar. As you see, we are quite some people. So the first one is this webinar is going to be recorded. The idea is that, as we know already, that August is not the best date for organizing this webinar. This webinar will be available in our website, so anybody would be able to access to it anytime. The next one is that we kindly ask the participants to stay mute unless the host allow them to speak. You have the possibility to ask questions. The idea of this webinar is to be interactive. We wanted to do it through Slido. So you have here one code. I'm pretty sure that most of you know already how this application works, slido.com. There you can post all the questions, and there will be public, and hopefully we will be able to address them, most of them. And if there's any question that we cannot address, during the webinar, we will be able to do it after the webinar. The slides that we are presenting here, there will be also available in our website. So you don't need to copy anything. There will be shortly available after this meeting. And maybe just going back to the questions, in Slido we have the option to like questions. So if you like one of the questions that has been already posted, you can like it, and that way it will increase the visibility and we will be able to tackle it before that. So having, I mean, before the others. So maybe just saying that, we kindly ask you to follow these rules. And having said that, I would suggest that we shortly start them with the webinar. So we wanted to remind you, because as we were saying, this process started already in 2019, so nearly 5 years ago. This bidding review has been triggered by the clean energy package. And the first task that we had, it was the TSOs to propose a methodology and configurations for the bidding review. As you may remember, that the TSOs made the proposal, but the methodology and assumptions has been only approved later. I mean, it has not been approved by the NRIs, it went to ACER. So we have started a process in which we have followed the new approved methodology by ACER that leads into 2 steps. The first one was the approval of the methodology, which is the methodology that we are now following in this bidding review, and also the request for the TSOs to deliver the LMPs. This was the first part that was proposed. And the second part was the definitions of the alternative bidding zone configurations. The alternative bidding zones configurations has been approved on the 8th of August of 2022. And this was the initial and the moment in which the bidding zone review, the current process that we are talking about, has been specifically triggered. And this is where we are. As you know, what we are doing in the bidding zone review is that we are assessing the current bidding zones with alternative bidding zone configurations, following the set of criteria that has been defined in the CACM. It's a long process. It has been pretty difficult and pretty complex for us to arrive here. We are now here, and that's why we would like to give the importance of the current study, because it's a big piece of work what we are doing here. And now we are in the part of the public consultation. So as we also wanted to highlight that the current bidding zone review, this is what you have here in a circle. There's a commitment from the TSOs to deliver it before the end of the year. So the current process, both regions, Central Europe and Nordic regions, which are 2 regions that are doing the bidding zone review, will deliver the bidding zone review by the end of the year. In this moment, the decision making will start. This is a process that will be led by the member states. They have 6 months to decide if they are going to maintain or amend the bidding zone review. Maybe just this was just a quick reminder of the process of where we are in the bidding zone review. As I was saying, now we are going to focus now on the part that is circle here, and we wanted to also focus the discussion on the public consultation. All the process that we are now doing in the bidding zone review are following the bidding zone review methodology. As part of the bidding zone review methodology, this article 17.4 defines the public consultation, what we need to consult according to the methodology. And these are the 3 points that we are highlighting here. The first one is the impact of the alternative bidding zone configurations mainly on the following criteria: the market liquidity and the transaction cost, and the transition cost and the transition cost. That's why there are two studies that has been performed on both criteria, and these studies has been already published as part of the public consultation, and these are going to be the main part of our webinar today. The second point that we need to consult according to the legal requirements defined in the methodology is the possible measures to mitigate the negative impact of specific alternative bidding zones configurations. Regarding the reports on the market liquidity and the transition cost. And the third point that according to the methodology we need to publicly consult is the identification of some practical considerations regarding the timeline, different configurations, etc. So it's important to have in mind when you are answering the public consultation, and also while you are in this public webinar, that these are the 3 points that according to the methodology, these are the legal requirements we need to consult for the bidding zone review. As we are saying, we are willing to have as much feedback from you on these specific questions. And you have till the 4th of September to submit this feedback through the ENTSO-E website. Having said that, that was the very short introduction. I would like to pass the floor to our colleagues from Compass Lexicon, who has been leading both studies, the market liquidity and transaction cost and the transition cost study. And Fabian, Anton, Malte, the floor is yours.
Well, thank you, Marta, and good morning, everybody. Indeed, very happy to have the opportunity to present this morning the results of our work together with ENTSO-E. As a brief intro, we are an economics consultancy, and we regularly work with diverse market participants on a range of economic issues. And I'm here with Anton Burger and Malte Nussberger. We will jointly be presenting to you the 2 studies. So as you see, our role has been on the first study, the liquidity and transaction cost study, to provide an understanding of the state of liquidity today, as of now, the starting point, and then to try and understand the impact of reconfigurations of bidding zones on liquidity. And that's been done, I'll come to it in a minute, by looking at a range of indicators which allow us indirectly from the modeling that has been done by the TSOs to estimate the impact on liquidity, starting from the literature review. For the second study on transition costs, so there is much less of a starting point. This is an area where there is very little, if anything, in the literature. So the methodology has been fundamentally to rely on a survey of market participants. And the way we've done it is we've defined different groups, different types of market participants. We've developed a questionnaire. We've relied on these interviews to derive some estimates of the costs. Obviously, there's been some differences in the estimates, so we've had also to try and reconcile the different points of information we receive, and based on that, estimate possible ranges for the transition costs. So that's been our role. And as Marta said, we've not been involved in some of the other aspects which are part of the methodology defined by ESSER. For instance, some of the issues around mitigation are being dealt with separately. So if we go to the next slide, maybe just to give a structure to this morning's presentation. Yes, thank you very much. So we will start with the first study, naturally, before we go to the second one. And for the liquidity and transaction cost study, we will first start with a brief reminder on the scope and methodologies. And we will start, as I said, with the literature review. What does the literature tell us on liquidity and the way it is affected by bidding zone configurations? Then we will, based on the modeling done by the TSOs, assess the impact of liquidity in the different simulations of reconfigurations. That is going to be the first study. We will obviously pause to have some comments and discussion, and then we go to the transaction cost study, where, as I said, the methodology is essentially based on interviews. We will show you the data that we got, and we will explain to you the results in terms of transaction costs that we obtained. So let me go to the next slide and focus on the liquidity and transaction cost methodology. So as Marta said, this is based on Acer methodology. If you look on the left-hand side, Acer is pretty clear as to what they want to see in the analysis. There needs to be first a descriptive analysis of liquidity as a starting point today in the different market zones. Then there needs to be a correlation analysis to describe how their head prices in the bidding zones concerned are correlated with other bidding zones, their head prices, or combinations of these bidding zones. And then there needs to be a study of the impact on liquidity of potential changes. And as we said, the way we do that with ENTSO-E has been to rely first on a literature review and survey of existing status of liquidity based on a number of metrics, indicators. So this is derived, I would say, both directly and indirectly. And then for the reconfigurations, well, we have to look at these indirect indicators based on the modeling that's been done by the TSOs. One footnote that is important in terms of definition, it's fair to say that there is not a unique definition of liquidity. It's a broad concept. One can think of it as the speed and easiness by which assets can be bought or sold without dramatically affecting the underlying market price. But there are many different, I would say, dimensions to liquidity. We will explain to you in the next slides, based on the literature review, which indicators we have selected. Similarly, on transaction costs, it's important to delineate these transaction costs. And when we come to it, we will explain to you the way we have defined the boundaries around transaction cost, and in particular, the way we can isolate which of these transaction costs are linked to the bidding zone reconfiguration. What's obviously useful is to, for instance, start with a bid-ask spread, but we'll comment more on that. Another point I wanted to clarify is which of the bidding zones we are considering, where we are considering those which are potentially subject to reconfiguration. So that includes France, Germany, Luxembourg, Italy, the Netherlands, and Sweden. And the specifications we consider are those provided to us by the TSOs, so where there can be either multiple bidding zones in a country versus a single bidding zone, or where there can be modifications of existing bidding zones. It's important to distinguish also countries in which you have a centralized pool, with obligation to trade, the Nordics, Italy, Spain, and the other countries where we have a decentralized approach with bilateral trades. And finally, there are a number of regulatory mechanisms which may affect liquidity. And obviously, this needs to be kept in mind. Another point to highlight is the products. We are focusing essentially on short-term trading. We are commenting also on long-term trading and making that distinction. And essentially, that means we focus essentially on intraday day-ahead markets. We don't have data on OTC markets. So for intraday, we consider only the traded volumes. We consider that's a reasonable proxy. And for the long term, well, essentially, we focus on exchange-traded futures and non-cleared forwards. And you see the source of the data from which we show the different indicators and the beta spreads. So I hope this is clear. Let's move to the next slide. Obviously, we will say a bit more on the methodology as we go through the literature review. But before that, just I would say a caveat I have to mention. It's important to be transparent on what the study does and what it does not do. So essentially, there are limitations regarding the markets and products we consider, and then regarding the data and methodology. On the way we approach the different bidding zones reconfigurations, we do that on, I would say, a case-by-case basis, meaning that we look at each bidding zone reconfiguration potentially individually, but we do not account for potential cross-border effects in the sense that if you have multiple reconfigurations, they do impact on each other. We are, as I said already, not focusing on OTC intraday markets, but we nonetheless believe we have relevant data on intraday markets. We are also not, in the long term, able to comment much on some of the new emerging, very long-term markets, for instance, PPAs. 3, 5, 10 years, there's very little data, and it does depend, as you know, very much on the country in Europe. So I'm afraid there is not much data on liquidities there. When it comes to, I would say, the data themselves, we rely, as I said, on the modeling that's been done by the TSOs. Naturally, this is based on the intrinsic limits of these kind of models, but these are widely accepted, these market models and networks model as a good basis for projecting the evolution of the power system, but they come with some limitations. For instance, we don't model changes, potential changes in the behavior of traders. We know that there's potentially going to be, in the future, a lot more involvement on the demand side of granular trading, and that could change the dynamics. Our conclusions, as I said, are covering both short-term and long-term effects. But you know, some of these can be, I would say, attributed to the econometric analysis. Some of it needs to go beyond, and we limit our approach to what we can derive from the econometrics. So we may not be capturing the full effect there. As I said, we also are not accounting for non-linear relationships that can happen and mitigation measures, which are out of scope. So I think that is enough probably to set the scene. And let's go to the next slides. I will hand over to Anton, who will walk us through the literature review. That is our starting point for assessing the status of liquidity today, and also for assessing the relevant metrics which we should consider for assessment. Over to you, Anton.
Thank you very much, Fabien. Good morning, everybody. My name is Anton Burger. I am the project manager on this project, and I'm also leading the DACH energy work, co-leading the DACH energy work of Compass Lexicon. Let's jump straight into the literature review. As you said, the liquidity study has 3 main parts. The first one is the literature review. The second one is a sort of very exhaustive analysis of the current state of liquidity in Europe and how certain things actually hang together. And then the third part is some sort of view as to how liquidity may evolve, starting sort of the liquidity in the newly to be formed bidding zones may evolve in the future. But first, we looked at the view in the literature, and it is quite interesting to see that the literature on that is quite diverse, and it's not necessarily that all the authors agree on everything, but there's a broad picture that emerges. On the one hand, there are market characteristics, and that is what I'm showing to the left here. And the main market characteristics we are going to be looking at is the bidding zone size, overall market size, market concentration, how concentrated is the market, like how competitive can we expect it to be, and there are other characteristics as well, like for example renewable share in the market, but also things like how actively does the market trade with neighboring bidding zones, and how connected is it with neighboring bidding zones. And looking at those fundamental parameters is very important. Because what we need in order to assess the potential future liquidity of the newly to be formed market zones is some understanding of the relationship between liquidity metrics. Fabien has already mentioned them. There are different ones, and those are the ones to the right here. Traded volume, for example, churn rate, bid-ask spreads, time to maturity, and fundamental market characteristics. And that's an important, in a sense, part for understanding our study. When we look into the future at the newly to be formed market zones, we cannot simulate, in a sense, market liquidity, because there isn't really a model that has been built yet for that purpose. And so what we need to do is we need to, in a sense, predict, and actually the TSOs are doing that, predict some fundamental characteristics of the market, like market size, market concentration, res share, interconnection with neighboring market zones, and then understand what the relationship of those fundamental drivers with liquidity is. And then when we get a prediction for those fundamental drivers from the TSOs, we can form a view with regards to the future involvement of liquidity of those market zones that do not exist yet. And you can already see there's some caveats you need to do when you do that sort of methodology. But that is, in a sense, what we do, given the data available and given sort of the development of science in the field, I just say. And it is true, in a sense, those metrics we do use to assess liquidity are always going to be imperfect to a certain extent, and we are fully aware that there would be more measures with which you can measure liquidity, like for example market depth, and so on and so forth. Would have also been good to look at those too, but in a sense, scopes are sometimes also naturally finite. And what are then the expected relationships between those characteristics? Well, typically we would expect market liquidity, as measured by those proxies here, to increase with bidding zone size. That seems quite likely. Then we would typically expect an inverse relationship between market concentration and liquidity, like a more concentrated market can typically be expected to be less liquid. Often, and we also actually observe that, and Michael will come to that in the econometrics that we do, there's a positive relationship between the res share and liquidity, and that's kind of understandable. You need to trade more when you have a more volatile renewable portfolio. And with regards to the relationship between the interconnectedness to other markets and liquidity, it's not completely clear, because it seems like there are two countervailing effects there. One effect is that, in a sense, when there is an active market close to another market, it is more likely, in a sense, that the neighboring market will also be very active. But then on the other hand, there is also the proxy hedging effect. It can happen that one of the local markets, develops really well, and as such becomes almost like we can call it liquidity hub for the neighboring markets, where the market participants decide to trade. In a sense, Germany, of course, we'll see that became sort of something like that. Okay, let's go to the next page. we were also tasked to look at sort of examples of bidding zone splits that we have already seen in the literature. And there, a classical one is the German-Austrian bidding zone split. There, the literature basically shares a few observations, but we also looked at the data ourselves. So you will see a bit more on the next slide on that. It is interesting that DNV noted a slight increase actually in the ahead volumes around the bidding zone split in Germany and Austria. That's interesting, but it's more important actually what happens to the long-term products. And there, I believe the short message is German liquidity wasn't impacted very much, and the Austrian liquidity in a way never got off the ground. Yeah, but you will see a little bit more about that on the next page. The results in Sweden are largely similar. There have been bidding zone reconfigurations there already, and it is actually still a little bit unclear as to what precisely the outcome there was. In a sense, it seems like short-term liquidity wasn't impacted very much, but then long-term liquidity in the Nordic market actually hasn't developed particularly well in the last years. And there's still a little bit of a discussion in the literature out there as to why exactly that was. But yeah, it hasn't been developing super well in the Nordics, you could maybe say that. Then on Italy, there's actually not much literature that can be found, and we haven't looked into it ourselves in like very much. Okay, let's go to the next page. That's a little bit of data on how the German and Austrian market zone developed after the split. So what you see here is traded volumes of different futures products. To the left, you have the base month, in the middle, the base quarter, and to the right, the base year. If you look at quantities, you see the base year is the most important one. So let's for now just focus on that. And there you see that the liquidity, of course, of the combined Austrian-German bidding zone, of course, when the bidding zone was dissolved, disappeared, went to zero. But then, of course, most of that liquidity went into the newly formed German plus Luxembourg bidding zone and remained roughly, constant from there. And then there was a little bit of liquidity also in the Austrian bidding zone, but it never quite got off the ground. And we also spoke to market participants. Not many people actually trade futures in the Austrian market. It went like if you speak to market participants there, a lot of them will tell you that they actually trade on the German market. They use the more liquid German market for their hedging needs, accepting a little bit of a remaining base risk. Let's go to the next page. Yeah, here a little more on the German-Austrian development. You can in particular see that the bid-ask spreads, which are an important measure of transaction costs, they are quite high in Austria, and there are not even many data. So we do not show the Austrian transaction costs here, but you see that the development in Germany was, well, maybe I'm interpreting a lot here, like by and large unchanged. Yeah, so not too much happened to German liquidity because of the German-Austrian bidding zone. However, for the Austrian market, never quite got off the ground. So that's sort of what we learned from there. Yeah, and this is, I tried to be very quick, the literature review. And with that, I'm handing over to Malte, who will talk about the quite substantial analysis that we did with market data from all over Europe. I think we could even say that the analysis we did was sort of one of the biggest analysis of liquidity in Europe so far. We've really assembled a large, to that point in time, almost unique data set of trading data in Europe. And with that, I'm handing over to Malte.
Thank you very much. Also welcome from my side. I'm economist in Anton and Fabian's team at Compass Lexicon. So if you go to the next set of slides, we will analyze the state of liquidity. So this has been one of the requirements as per ASA methodology. And we will first talk about the starting point, which is kind of the current state of liquidity. And then in the second step, look into the relationships between the liquidity metrics and market characteristics as introduced by Anton and Fabian. So what you see here first, it's of course, because of this public consultation, only a short spotlight of the selection of the analysis that is then complete in the report. Here we show the exchange traded or the liquidity of the exchange traded short-term products, the day-ahead market traded volumes and the intraday market traded volumes of the affected zones. And as you can see, maybe firstly on the left-hand side, the monthly aggregates of the traded volume is such that in Italy, we see the highest volume actually, Germany the second highest, or Germany, Luxembourg the second highest, then Sweden, then France, and then in the end, the Netherlands. This is notably due to the difference in the nature of the exchange, right? Because in Italy, you have several zones, so therefore you are inclined to trade on the exchange, whereas in Germany, Luxembourg, for instance, you still have quite notably a lot of bilateral trades. Despite this, on a general level, you see that the day-ahead market did not develop very substantially, so you do not see a very clear trend upwards or downwards throughout the years. There is especially seasonal variation in countries, for instance, Sweden, but also Italy, that is partially due to just strong differences in demand due to temperature. Actually, we've done this analysis as well. On the other hand, you see on the intraday market, the intraday market is substantially less developed when looking into the liquidity metric, traded volume. So only a fraction of the amounts traded of the day-ahead market are seen in the intraday market. You do see particular traded volumes in Germany, Luxembourg, and in Italy. And you also see an upward trend, at least for most of these zones besides Italy. But regardless, the intraday market is still kind of less liquid than the day-ahead market. So that's the starting point where we are, and kind of what will then be kind of considered the basis for analysis. Besides the short-term products, we see long-term products in the next slide. And here, if we go on to the next slide, we see we have provided two figures here. Of course, in the report, there's a more substantial analysis of it. On the one hand, you see the long-term products traded volumes across several venues, so both EEX and Nasdaq, and also OTC volumes as collected by DIBA. And what you can see here is, as indicated by Anton, Germany, Luxembourg really has the significantly highest traded volumes, so liquidity, since its existence, more or less. In comparison to that, the other zones have relatively little liquidity here. However, when we compare this to the bid-ask spreads, which you can see on the right-hand side, here we see that while Germany, Luxembourg still has the lowest bid-ask spread, indicating the highest liquidity and the lowest transaction costs with regard to this spread. Notably, this significant difference that you see in the traded volumes is not as strong when you look into the bid-ask spreads, right? So while Germany has the lowest bid-ask spread, the Nordics, for instance, which is more or less indicator for Sweden, also have quite low spreads. So that's also a starting point on long-term products. And on that basis, we then have tried to identify the relationship between liquidity metrics and market characteristics, and the approach that we show on the next slide. Yes, thank you very much. And essentially what we have tried to do is develop a regression analysis to identify the relationship. So this regression analysis is not intended to indicate kind of causation. So we do not state that the market size leads necessarily to this liquidity metric, but rather that there is an existing relationship between the two. So essentially what we do is on the dependent variable, which means kind of what we try to explain by that, are the liquidity metrics. And these liquidity metrics have been explained by Anton. They are traded volume, they are churn ratios, they are bid-ask spreads. There is some kind of detail and nuance within that. So how do you actually determine traded volume? Which bid-ask spreads do you use, and so on. So there are some specifications on that, but this is kind of what we have on one axis, or if we have multiple explanatory variables, it's a multi-dimensional space, but it's kind of what we explain. And then on the other side, we have the explanatory variables, which are the market characteristics. As also indicated by Anton, on the basis of the literature review, we have used a selection of variables, most notably, of course, the market size, but also the share of variable generation as a test, or the market concentration. As indicated, seasonality has been considered in some of them, and cross-border participation through a proxy by looking at price correlation has been considered. And we have looked, okay, if the explanatory variable increases by 1 in that, like for that instance, what happens to the dependent variable? That's very, very simply speaking, a regression analysis. And then you control for noise, which means kind of other variation that is then considered an error term. Well, that is considered outside the explanatory variable that may impact the dependent variable in the data that we have. So this is actually kind of analysis on the basis of existing data. Besides that, there is one additional point relevant, which is the functional form. So in a simple regression analysis, you would often assume a linear relationship between the explanatory variable and the dependent variable, which means the first unit of increase in market size and the 100th unit of increase in market size more or less has the same relationship for traded volumes or some other liquidity metric. However, that is not necessarily the case. So there can be nonlinearity, and we will see this later in this presentation, and we have checked for that as well, at least to the extent possible. So maybe why this methodology, of course, builds on econometrics. It is not an econometric analysis as such, but we try to, of course, use this method in order to identify the relationships. That being said, we give a short introduction to some of the results. Notably, these results are essentially multidimensional, so showing them is a bit of an oversimplification, but it still is helpful to some degree. And so just to give you an indication of kind of what it could look like, is here a view on the liquidity relationships in short-term markets, where we see the market size relationship to the head daily traded volume. So market size as the characteristic, traded volume as the metric. And here we see this relationship for the different days in our sample across the different countries. Here you can also see that we have not reduced our regression analysis to the countries that are subject to a reconfiguration, but we have extended it because we wanted to have as comprehensive understanding of the relationships as possible. And what you can essentially see, for instance, is that you have a rather strong, or generally a rather strong relationship between market size and traded volume. So the higher the market size, the more traded volume you would expect. This relationship is, however, a bit muted, at least for France, where you see an increase of market size does not have a very strong impact on traded volume, and also for Germany to some degree. A very similar picture can be seen when we do the same regression analysis or the same kind of show of dependency when you're looking into the intraday traded volumes. You see similarly a positive relationship between market size and traded volume, and again a muted relationship, for instance, for France. For those who are very keen on econometrics, you see very strong heteroscedasticity. So this would notably kind of create an issue for our robustness of the significance, but also, so we have done checks to some degree, but please bear in mind that kind of the final values of change are not the main sought after results, but rather the kind of relationship of change, right? So just kind of, is it a positive or a negative relationship? So with that, I give the floor back to Anton, I think, on one of the details of this long-term market relationships.
Yeah, thank you. Let's have a quick look at the next slide, which I think is one of the, in a sense, most visually striking ones, and I think one of the most interesting results. One of the questions we are asked is in how far there can be such a thing as enough liquidity, and there is no definition of what enough liquidity really means, but you could say, well, enough liquidity could mean that more liquidity wouldn't give you much lower transaction costs anymore, right? Because you do not necessarily want liquidity by itself, right? It's not a mean in itself. You want it to have low transaction costs such that market participants can hedge themselves at lower costs, and then this is obviously very important for market participants. So what we did here is we used different measures of liquidity, and that you have on the horizontal axis, like exchange traded volume, churn rate, and market size. So just like different measures you could use for market size, and a measure of transaction costs, like the upper one is the minimum bid-ask spread, and then the lower one is the mean bid-ask spread. And you see that in all of those figures, you have more or less a fairly good negative relationship between those. So what you can say is that, well, it seems like a bigger market makes the market more liquid, and as such reduces transaction costs, and that's a good thing. Oh, that's a good finding, let's say. And then you can also see, of course, that it may well be that the relationship is a bit nonlinear, yeah, so that there is a point after which more liquidity doesn't actually add very much anymore. Yeah. But then you also see that probably, given the sort of, the noise in the relationship, it is pretty hard to tell, like, when exactly that happens. So that's sort of what we see here, and it's an interesting learning, I find. And with that, I hand back to Malte.
Yes, thank you very much. So now noting this first step where we have identified kind of the state of liquidity and the relationships between market characteristics and liquidity metrics, we then have looked into the reconfigurations. So if you go to the next slide, we have conducted a kind of 3 steps to make an estimate on what the reconfigurations could mean for liquidity on the basis of the analysis just shown in a nutshell. So first, we have analyzed the simulated data that we have received from the TSOs, particularly with regard to the market characteristics that we can obtain and we considered relevant. Then we have considered implications for the alternative configurations. So we have looked into the relationships between the liquidity metrics and the parameters of the market characteristics. And then we have derived expectation changes. So, so first, what it is, then how are the relationships, and then what does it mean? The three market characteristics we have looked at are market size, market concentration, and price correlation. This is also in line with ESO methodology and with the results that we have obtained from this regression analysis of the historic data. Essentially, by market size, we expect a positive relationship. So an increase in market size would imply an increase in liquidity metrics, or the other way around. Market concentration is the opposite. So an increase in market concentration would imply a decrease in liquidity metrics. Here we need to be mindful of the indicators, because the indicators themselves can be also inverse to market concentration. And then finally, in price correlation, we see an increase in price correlation implies ceteris paribus liquidity enhancements, because you have kind of a more a larger market and more often. So that on the methodology, and then maybe we can go to the last slide, where we have a very condensed outline of the overall results. So maybe firstly, you see kind of the different or countries or current zones, right? And the proposed configurations that have been assessed. Maybe as an overall statement, you can see that, well, most market sizes decrease after the reconfiguration. And also most market concentration decreases, while on the other hand, price correlation on average actually increases. So of course, there are nuances between different zones, between different cases. But as an overall picture, this is quite stable. Maybe Sweden has it a bit different. And on the basis of these market characteristics, we have specified an estimate of what could this mean for liquidity metrics. And here, maybe to go through the different countries or zones for Sweden, if you in these cases where you decrease the number of zones, you would see an improvement of liquidity metrics, or we would expect that, at least from the analysis we've done. While, for instance, for zone 10, you would expect an impairment of liquidity metrics. And for reconfiguration 11, it is rather inconclusive because the market characteristics go into different directions or are very limited. So from the basis of our analysis, you cannot actually form a clear expectation. For Germany, Luxembourg, we see like significant decrease in market size, while price correlation at times increases. Therefore, we see that for long-term markets, mainly because of the significant decrease in market size, you would expect a decrease in liquidity metrics that is kind of not offset by some increase in correlation. However, in short-term markets, while you see this impairment due to market size, you could see exceptions in specific then smaller zones because of this increase in price correlation for the short-term markets. For France, you would primarily see, or we expect a decrease in liquidity metrics for long-term markets, driven by the indication from the market size. As is the case for Germany, Luxembourg, for the short-term market, it is not that clear. So there is a potential exception because this increase in price correlation could actually offset some of the negative indication from market size. Netherlands and Northern Italy are similar in and of itself with regard to their potential reconfiguration. And for both, we see essentially a tendency to impairment because kind of there is no significant increase in any of the market characteristics that would warrant an expectation of a liquidity increase. So that's it in a nutshell, and I think we can open the floor now for discussions. Thank you very much.
There's just one more thing on the market concentration measures in Germany. Yeah. So what you see here is a slightly aggregated picture. Please mind that there are going to be market zones in Germany where the market concentration is going to go up as well. I'm asking this because in sort of previous discussions, this has been a question. That is why I just want to say it right away. So basically, mostly decreasing doesn't mean it decreases in every configuration we looked at. And the reason why it's mostly decreasing is because typically in the residual supply index calculation, the market gets smaller as like when you have a bidding zone split, the market gets smaller. So normally you would expect the market to become more concentrated, but also the interconnection with its neighboring markets on average would go up, which is why overall you actually have this effect here mostly decreasing. I just try to sort of prevent questions that would be going into that direction, but now I'm looking forward to the discussion.
Okay, so I would suggest then that we use the slide application. So I don't know, Malte and Tom, if you can see already the questions in Slido. My suggestion will be that we can maybe start by the ones that have the highest likest, but some of them are general questions not directly related to this study. So for those questions, we will tackle them in the third part of the workshop. So maybe we can start by those that are related to this. And as I said, in the third part of the webinar, we will tackle the general questions. So we see already there are a lot of questions about the decision making, the different indicators, but now let's focus on the one related to the liquidity study. So how shall we do it? I don't know, maybe Georgie, shall we show the questions
yes,
in the screen?
I can put the Slido on the screen, and as you said, we will answer the questions. Just give me 1 second, please. So I will project it. Please let me know if you can see them.
Yes, we can see them. So maybe we put, I think, yeah, they are already by popular. So yes. I think we can skip the first one because we will tackle it in the third part of the webinar, as I was saying. Second one's the same. It's a general question not related to the study. Maybe the first one that we should answer now is this third one. Has the study looked at cross-border effects and effects on adjacent market for the bidding zone reconfiguration?
Yeah, maybe I'll take that one. Yes, we did look at it. And we tried to capture as well as possible also within the econometrics that we did that effect. As said already, in the econometrics, it comes out ambivalent. So we cannot quite, should I say, cleanly econometrically model the effect. And that likely is because there are two countervailing effects here. On the one hand, liquidity may be contagious. A liquid market may well have a liquid neighboring market. But then on the other hand, liquidity also, is behaving in a non-linear way, in the sense it has a bit of a tendency, it seems, to create hubs, to create favorite markets where everybody trades, because once such a market is established, everybody is going to go there. To a certain extent, we see already Germany being such a market, where, for example, the Dutch would trade or Austrians would trade. It would be, you can trade more cheaply there. Yeah, so yes, it has been considered and discussed. There's no theory yet that would allow us to model it precisely, and this I just try to give you a bit of a flavor of the complexity there, and that's where I think I can leave it for now.
Okay, so I will mark it as answer that it was considered. So that
Yes,
answer
and maybe I can add a nuance, and this will be the link to the next question, I think, in the list, which is, yes, we have looked at cross-border effects, but you remember the, I would say, nuance I introduced when I presented some of the caveats. We look at it on a standalone basis, in the sense that we look at it country by country or zone by zone, and there can be interactions between different reconfigurations. That is naturally a limitation, but I think it's a fair simplification to do, because should there be several bidding zone reconfigurations that interact with each other, then there could be cumulative effects, right? But I think, yeah, it's important that we have this caveat. And if we look at the next comment, perhaps, I think if you can hide perhaps your box. Yeah, the next comment is, don't you think that assessing the impact from the sole perspective of one country is missing the purpose of the split? I interpret this question as saying there are effects on the country, but there are also effects on the neighboring countries, and then there are overall effects. I think this connects to the previous question, in the sense that we have considered cross-border effects. So yes, we are looking not just at it from the point of view of the country, but from the point of view of cross-border effects. However, with the footnote that we look at it, configuration by configuration, rather than looking at cumulative effects. But I think we can say that we are also addressing that question here. Yeah.
Yes, and one interesting thing here is that on the one, we look at liquidity and transaction costs here, so, which maybe by their nature are a little bit more focused on a market. There will be other parts of the bidding zone review, that have more to do with the wider effects on the electrical systems of Europe, where you may be seeing more even more cross-country effects. Yeah.
Okay, so we consider it is answered. Then we can move on to the next part. I believe this is answered. Yes. We also provided a link, I believe, in the chat. Would you like to take these questions?
Maybe I can have a first go at this. So yes, the relevance of renewable energies, we have considered that as well. However, in the regression analysis results, the results were not such that we could conclude that it is a very strong relationship so far, which may be especially prone to kind of the current state of renewables outside of the market, for instance, or kind of subject to subsidies and so on. So notably, kind of the relevance of renewables for liquidity will probably evolve, but so far for the reconfigurations, we have not considered that because of the kind of historical show that it was not yet very, very substantive. But for the future, it can, of course, play a role.
But in a sense, those studies on the effect on renewables those are very good questions, and I think they're extremely relevant. Partially, the answer goes a bit beyond the remit of what we were tasked to do here, right? We were tasked to look at liquidity and transaction and transition cost effects, sorry. What you're hinting towards, are sort of further reaching measures with regards to the risk perception of market participants. And yes, that could increase. Yeah. There could also be effects with regards to the higher price volatility you would be seeing in smaller zones. Yeah. Could be some of that as well. And then, of course, there is a big topic as to how certain market arrangements and feed-in premium are only one of them, would be adjusted in the face of a bidding zone review. Yeah. Currently, we have that under the heading of mitigation measures, and there would be, if such a bidding zone change actually happens, there would have to be a whole bunch of mitigation measures. Potentially, the adaptation of feed-in tariffs just being one of them. But reading those questions, I see that some of the issues that would pop up there, you already have on the radar. Yeah. So I don't know if that was very helpful, but I thought it gives additional perspective to what you're asking here.
Okay. Any other particular question that you would like to tackle now? Because we have a few more minutes before the next.
Maybe we can tackle the question that you have here. Is it obvious that a larger zone means higher liquidity? How can this be questioned? I think there are things which are intuitively obvious, and the fact that the size matters is one of them, but there are things which are a little bit more complex in the way liquidity emerges. For instance, if you think that liquidity arises because of the need to trade, it is also related to the question of where supply and demand, so generation and consumption of electricity, are located. And this may be in a specific part of the country, different from the other part. And in a sense, a bigger zone in itself is not directly relevant here if actually most of the need for trading is concentrated in one single part that is also very relevant, for instance. And then there is a question of the need for trading is not just driven by the need for selling production to an off-taker, but to the risks that emerge in power system, I would say, operations, on the scheduling, and also on the opportunities related to the hedging and the trading of this electricity. There are many drivers, as we have just discussed, of liquidity. So I think, to answer this question, we are not questioning the intuition that larger zones in general lead to better liquidity, but we are trying to go one step further to understand if there is a reconfiguration, if there are smaller zones, what would be the actual effect, depending on the criteria I just mentioned, and depending also on the evolution of the supply and the demand going forward, because it's not just going to be the same as today in the future, right? The location of generation is changing in the modeling, and so is potentially the location of demand in some cases, where there is more active demand, for instance, associated with transport, EVs, etc. So a lot of what I said is obvious, but I hope it provides some background for why we are going beyond just a simple geographic split effect.
Maybe we can
mark it. Yes, Malte, please. Sorry.
Yeah, no, I mean, if we have time, we can maybe cover one or two more questions that I've seen. which relate to on the top, if you stay there, if neither intraday nor long-term trading is taken into account, and also kind of the question on the centralization of the year ahead and was it 2 year ahead long-term products. Well, both intraday and long-term products have been taken into account. It is true for intraday that the data is limited, so we have only traded volumes on a daily basis, but still we have taken that into account. And on long-term products, we have taken that into account as well, and also not only year-ahead products, but also more short-term products like quarter ahead and so on, month-ahead products. And also we have at times assessed more than only the year ahead, but also the 2 year, 3 year ahead product, depending on availability and kind of the use case, at least for the historic data. We've also looked into kind of cleared OTC data where possible from Libra. So this is quite substantive. And also the bid-ask spreads have been calculated on a tick level basis. So also here we have been, we try to be as thorough as possible with the data we were able to obtain. Of course, for the reconfigurations, this data is not available. So therefore, kind of it is a very strong reduction in complexity compared to the historical analysis, simply because kind of this data is not available anymore, as explained. So here you then, of course, only differentiate between short-term and long-term, whilst in the historic we actually do consider a range of products that were obtainable.
There's the question that I just see here when I sort by market from Robert Gersdorf. He says a decrease of market concentration in smaller zones is counterintuitive. It needs to be challenged and or better explained, proved. Yes, this is what I tried to touch upon with my remark before. Yeah. It is not the case that generally market concentration gets better in smaller zones, but there are some effects. Some of them are countervailing here. It's just important to keep that in mind. So that's why I wanted to, stress that one more time. And I think we've also managed to describe it in a quite balanced way in the report. But I completely agree that there's a complexity there that needs to be fully appreciated.
Maybe looking at the time, we should go to the next part, and then maybe if we have time in the next Q&A, can cover also some of the remaining questions, if you agree.
Yeah, I think it's a good proposal. As we were saying, the idea is that we will not leave any question unanswered, even if we are not able to do it during the workshop. All the questions will be, we will publish the answer to all the questions after this webinar. So let's go then to the transition cost study, and as Malte and Anton were suggesting, in case we have additional time, we can tackle additional questions on the liquidity study after. The floor is yours.
Maybe I introduce the approach and methodology for the transition cost study. So let's go to the next slide. So fundamentally, this is something which is new in the sense that if you look at the literature, there is very little on transition cost for bidding zones. So perhaps on the next slide, I'll share with you what we have done and how we approach it. Thank you. So first on the definition side, what is important is that the methodology explains that there are some mandatory aspects and then some optional ones for consideration. And on the mandatory side, on the transition costs, it's important to have a clear definition of what are these costs. What is being clearly explained is that this should be one-off costs. So these are costs to be incurred in case of a bidding zone reconfiguration at the moment of the reconfiguration. But these are not costs which you would have as an enduring cost over time, because it is assumed here that these are running costs, if you want, which are to some extent independent of the reconfiguration. So the first point is that we should capture only the effect of this one-off transition to the new configuration. And that is not easy, of course, because you have to delineate, you have to limit the time horizon to separate what is one-off and what is, I would say, recurrent costs. Second thing that is mentioned is that it should relate specifically to the adaptations that are related to the change of bidding zone configuration. There are many other reasons why you may incur costs. You may need to adapt your IT processes, your operational approaches, and you may do that independently of the reconfiguration. So therefore, we need to separate what is solely or directly, if you want, related to the change from some of the adaptations that you would do on the occasion of the change, but are not directly related to it. And that, again, is not easy, because obviously, if you have to change your setup, you would naturally consider some of these adaptations. If we can go back, please, to the slides I was going through. Yeah, thank you. And there is some specific wording from Ether on that, that, for instance, the transition costs should not relate to adaptations that are in general necessary to ensure flexibility in the system when there is variability in the number of bidding zones due to future potential amendments. So this is even more tricky, because it means we have to separate some of the costs that you would keep there as having an option to adapt to future changes. Anyway, I think it was important for you to understand this background, because it will explain the way we have structured the questionnaire and some of the challenges we are confronted with, to also warn you that it is not easy to reconcile some of the cost estimates we have obtained in different countries. Because I think it's fair to say that, as you see, the definition here is leaving some room for interpretation on some of the points, and therefore we are not able to I would say dissect the way in which people have answered to our questionnaire on some of these costs. Anyway, I think that was an important preamble, and the objective of the work we've done is to try to get a range, as it is put in the table on the right, of the cost estimates, with naturally some I would say uncertainty around that range, as we will explain when we come to the results. So let's go to the next slide. I'll briefly introduce and hand over to you, Anton, to carry on. The way we approach this is naturally through a survey. A survey, which means we designed a questionnaire. And that questionnaire was gathering data. And then we have processed the data and information that we received to obviously make it comparable and to make sure we understood and could, I would say, review the quality of the data, not in the sense of being wrong, but in the sense of being comparable with each other. So with that, I'll hand over to you, Anton, to perhaps provide a little bit more granular information on how we separated the different groups of participants and what the questionnaire contained specifically. So over to you, Anton.
Yeah, thank you, Fabien. So, obviously your task was to, put together that questionnaire, and that has been consulted quite extensively, both with the relevant people at ENTSO-E and also with ESA, actually. It is interesting that initially we asked a large number of different stakeholder groups, like, wholesale retail market participants, market infrastructure providers, network operators, others, and so on and so forth, for their, for their costs. And we also try to, understand those costs from the few vantage points of very different players in the market. Because if you look at it, and if you think about it, obviously, the different groups could be affected very differently. Now let's maybe go to the next slide. This is a bit of a first view with regards to what the questionnaire entailed. The questionnaire in the end was very detailed. And it is interesting, from some participants, we got the feedback that the questionnaire is much too detailed. From other important stakeholders, we got the feedback that the questionnaire is not detailed enough. So we hope in the end we struck the right balance between those two influences that we had. And we ran with what we did. In the end, we got back a fair number of responses, although, and we're going to be very transparent and open on that, not too many. Yeah. So what did we look? As Fabien already said, there is a bit of a logic here to the overall bidding zone review, and as such, the way in which we collect those data needs to really reflect that logic. So in particular, costs that are in a sense only, valuation costs, when assets are valued up or down because of the bidding zone review, that's not supposed to be in there. And then also costs that are going to be that are sort of an investment also in future bidding zone changes are not supposed to be in there. You can see, of course, that it is tricky to delineate. So what did we look at? Well, changes to internal business processes and IT systems. So those would be the biggest cost item we would think that you face when you have to adopt to a bidding zone split, an adjustment to termination of contracts and regulation. As it was said already before, CFDs might change, feed-in tariffs might change, market premier contracts might change, even PPAs may have to be partially rewritten because of the bidding zone split, and that will cause costs. So, but we don't, of course, want to, estimate the costs of revaluations but the costs that would sort of create for market participants in terms of, well, you can call it red tape if you wish. Then, of course, adjustments of processes and also additional costs we asked for. For more detail, maybe have a look at the report, also have a look at that slide deck. But I think you're getting an idea of what's in there, and maybe also sort of why we put it in there. Let's go to the next page. We got a fair amount of numbers back, and let's just say, we didn't do, in a sense, an audit like an auditor would do. Yeah. So it is not a cost audit, but of course we did quite a large number of quality checks with the data. So, for example, we looked at matching, we looked at outliers, we looked at in how far it fit and made sense in order to really, make the best use possible out from those data. And we actually also then went back to respondents quite a lot, asked them how things need to be understood, interpreted, and so on and so forth. Maybe let's go to the next slide. This is a very brief outline of how we did the extrapolation then. We got a lot of data back, and then, of course, we had the methodology for how to extrapolate then to the whole market size. And there, let's just go through it really briefly. We basically first got the data in, then we had, you see that to the very left, certain quality checks on the data. Then we got the total costs of a certain company. But then in order to scale them, we were thinking a little bit, okay, there are costs that you can in a sense that scale with the size of the company. And those are then costs we scaled with market size. And then there are costs that may not actually scale with the size of the company that are related to a bidding zone, that are sort of, fixed costs of a bidding zone review, that we sort of said, okay, that's probably independent of company size, and those we scaled by the number of companies in the market. So we tried to make a distinction here, and then in the end, got to an overall total cost estimate. Again, for more details, I sort of, please have a look at the report. But this is sort of to give you a first, overall understanding and flavor of how we have been doing it. And let's now maybe briefly jump into the limitations of the analysis. It's important to just also be very clear as to what we have here, what we learn from that, and also what are the limitations and what could then, of course, be the next steps in research and so on. Let's maybe go to the next slide. So what are the limitations? There are three overall, areas of limitations. The first one is data quality. The second one is the number of responses and the aggregations of organization types that we have been doing. And yeah, and then sort of the overall number of responses. So let's look at data quality first. The cost estimates, let's not forget, have been provided by market participants voluntarily. Yeah, so they have, of course, in a sense, we are not a regulator. Yeah, we cannot tell companies to give us certain data, so they have to, invest their own resources in order to give us those data. So that's maybe just like really important to keep in mind. So there is a degree of heterogeneity in the data, and there are probably going to be some different interpretations as to what is what. And there will be some idiosyncratic factors in the data as well, and maybe there will also be some limitations to accuracy as well. And maybe sometimes it cannot, of course, rule out that some of the answers are biased, or that maybe sometimes the questions haven't been fully understood. However, we've done best efforts that we could in order to make it really understood. We've done a public webinar on the questionnaire. We explained the questionnaire as much as we could. We also reached out to participants and did even specific guided interviews with additional participants in order to, really educate them and get more data. It was also quite interesting that partially we dealt with multiple organizations, in a sense, sort of organizations that are multiple organization types at the same time. So in the end, we aggregated the companies quite a lot and basically said, well, you know what, we'll make a distinction between companies that do have balancing responsibility and market participants that do not have balancing responsibility. So this was in the end sort of the categorization that we have used. As said, we have received 42 answers overall. And yeah, there were some sort of significant efforts from our side to get more responses, to really get the data to a conclusive form, and to also discuss what we're trying to get with market participants as much as we could. And with that, I'm handing over to Malte again, who's gonna talk you through, after the health warning, Malte is now gonna talk you through the results.
Yes, thank you very much. And I think these limitations should be borne in mind while I explain what we have received and what we have kind of made with that. So if you go to the next slide, please. We will look first in the databases, and on the next slide we see kind of the answers that we've received and their respective completeness, because of, as stated by Anton, this kind of trade-off between various stakeholders stating it's too complex or not complex enough. But essentially, we are in a 2-digit number of responses that we've received. and the responses that we have received have partially not been complete, but where possible and useful, we have still used this incomplete data. For instance, when they have not indicated their market share, where they have not differentiated between dependent and independent costs. We've still tried to include that where possible. So what you see are the different countries or zones. So Germany, of course, includes Luxembourg as well. For France, we have more or less one complete respondent for wholesale, TSO, and market infrastructure providers. We have a set of incomplete data received for wholesale retail and for one TSO. For Germany, we have received complete data for TSOs, DSOs, market infrastructure, and wholesale retailers, as well as some incomplete data. For Italy, the data is very limited, so we have only received incomplete data in the wholesale and retail segment. But other than that, we have not received any data actually. For the Netherlands, it's similar as for France. And for Sweden, it's also somewhat similar that we don't have a DSO. We also don't have a complete data set for wholesale retailer, but a couple of incomplete data sets. So that being said, public administrations, we do not include at all in the, or cannot include at all in the transition cost estimate. And for the others, the data set is limited at best and reduced in any case. So comparability across the different final transition cost estimates is also not given, because for instance, for Italy, we cannot include the TSO costs and so on. So that being said, another differentiation of the answers to the questionnaires can be seen in the next slide, which refers to the differentiation between costs independent of company size and costs dependent on company size. So this has been one of the aspects relevant for the calculation of the total transition costs. Here, this differentiation has not been relevant for, or has not been considered for TSOs, market infrastructure providers, and public administrations, but has been considered for wholesale and retailers and for TSOs. And here also kind of the number of observations. These are larger because, of course, a company that has provided data has not only provided data for one reconfiguration, but for several reconfigurations, and therefore expands the set of observations if they, for instance, differentiate, or if they state that there's no difference in regardless of the number of zones that we then have after a reconfiguration. When we differentiate between kind of the different cost segments, we see that kind of we have received most observations for the top cost segments, so business process, IT systems, reporting obligations, and renegotiations. We have received more data for costs independent of company size than costs dependent on company size. So apparently the estimate of cost dependence on company size has been more complex, or the market share has not been available or so. The DSOs, interestingly enough, but well, they're only very limited DSOs. There's no differentiation with regard to company size, costs, and independent costs. So maybe the main takeaway is that kind of the data that we have received is rather limited, but it exists for all cost categories, and it exists in some but not all kind of types of companies. So if you go to the next slide, we see a first kind of analysis of, well, on the one hand, you can consider this a view on the data completeness, but on the other hand, you can also kind of consider this the first kind of qualitative indication of what these transition costs are about. So here the question that we are posing is kind of the size independence of data points. So the respondents have indicated if they expect that these transition costs are actually dependent on their companies or not. And for instance, what you see is that business processes and IT systems are expected to be largely size independent, which means market participants or these respondents expect that kind of everyone is going to have the same costs if he or she participates in the market. Whereas other types of costs, for instance, processes or redrawing of legislation. Well, redrawing of legislation is not kind of you as a market participant redraw, but you react to that such change, are rather dependent on company size. That as an overall picture. In business process and IT systems, just as a short highlight, will be relevant or especially relevant for us in the next points as well. So if you go to the next slide, we then can start talking about the results. So if we take this as the kind of starting point that we see, the first results we will look into kind of wholesalers and TSOs on a size independent cost, so where we do the differentiation, and then kind of we will go one by one, right? So in terms of size independence of sizes independent of company size, here we see that in wholesale retail the major costs are expected to be in the business process and IT systems. For TSOs, they also expect the major cost to be in IT systems, whereas business processes, but this could be kind of is rather understandable, is not as strong. You also see that kind of on average, but I mean, the number of observations is limited. On average, wholesalers and retailers expect significantly higher costs than TSOs. As a short explanation on the methodology, if the sizes are independent of costs, we then scale by the number of participants, and naturally needed to use some kind of proxy for that. So for instance, for wholesale and retail, we've used the number of BRPs to then scale that. On the next slide, we see there's kind of the same types of companies, but then the size dependent costs. So if we go there, we see, I think we now skipped one slide. Thank you. Yes, thank you. Here on size dependent size dependent costs on company, we see again that IT systems are particularly relevant for the wholesale and retailer. Business processes arguably are not that relevant here, whereas for the TSOs, we also see as again IT systems as the primary factor, but also business process and renegotiation or termination of contracts as a relevant cost category. Similarly, as we have for the size independent cost by cost category for the companies, we see that wholesale and retailers are expecting significantly higher costs on average. Then when we turn to the results from transmission system operators and market infrastructure providers on the next slide. Thanks. We see a rather similar picture again, that IT systems, so this is kind of one of the main findings, IT systems really do play the biggest part in terms of cost, followed by business processes. This is true for both the TSOs and the market infrastructure providers. And we see the TSOs, I mean, they also have like there are only very few TSOs but they have by far the highest individual costs, with costs ranging above 10 million in parts per cost category. Similarly, market infrastructure providers, I mean, the number of observations is limited, but here costs are at or slightly above costs for a wholesale market participant, without if we do not scale or so. And then finally, and I think that's the last slide we have here for the transition costs, is the overview of the total estimates. If you go on the next slide. And please, again, be reminded that kind of comparability is not really given because different other stakeholders are included depending on data availability. But what we can see from the data that we have obtained is that there's a large variation in expected costs. So while Sweden expects very limited costs, but of course Sweden had been, well, Germany had been affected as well. But Sweden is smaller, expects very low costs. Germany expects below 100 million. Germany expects costs above 1 billion, right? So maybe going through it one by one, you see that across all reconfigurations, you see that besides for France and Sweden, you see that kind of wholesalers and retailers expecting the highest costs. This may be due to the scaling as well, because if you consider that size does kind of costs do not depend on size, and you scale by the number of participants in the wholesale and retail market, it's just very high. Whereas, for instance, for France, you would see very high costs for other stakeholders. But this is also due to kind of the limited number of wholesalers and retailers there, and the data we have obtained. You can also see that the variation in estimates or the range is quite substantive. So for instance, for Italy or for the Netherlands, there's a variation of kind of below 50 million to above 200 million. Similarly for the Netherlands, actually the highest estimate is above 400 million. So also here, there's really no certainty that you can see. And when we now go to Germany, we see kind of, it looks a bit like a smaller range, but in total numbers, the difference is still kind of between 1 and 1.5 billion euros, or even above 2 billion euros. And we already excluded one outlier that would have expected significantly higher costs. So that being said, all in all, we have identified ranges on the basis of the data that we have obtained. But as said, these ranges are quite substantive and subject to, of course, the various limitations that we have seen. But a more comprehensive analysis of it is, of course, shown also in the report. So that would be it in terms of a short summary of the transition cost report, in terms of what was obtainable. And I think we can open the floor now again to discuss questions. Thanks.
Thank you very much, Malte. So I would suggest that we do it the same way we did before. We can show the Slido in the screen. We can go through the most popular questions related to this study, and you can tackle it directly from there.
Perhaps we can skip those questions that we said we will answer later. But I think we can start with this on the transition costs.
Yes, maybe I can have a first go, but please, Anton, Fabian, complement. So yes, we have seen and we have discussed that there exists a set of studies on transition costs for other regions. But we question a bit the comparability of these studies. One, due to the kind of definition of the transition costs, and two, due to the kind of that is kind of defined as per ESA methodology, and two, due to the kind of consideration of which market participants are considered, right? And therefore, we don't think it is really comparable. But of course, we also know the limitation of data that we had to come up with the range. So also there's of course some uncertainty with regard to the 1.1 to 2.5 billion, for instance, that you have stated here, as this is kind of from the limited number of responses that we have received, and only that.
Okay, so I can mark it answered, I assume.
Maybe there was the second where Sweden was compared to Germany. Yeah, and so here there are again 2 points. The first point is that well, comparability is not really given because there are different types of market participants included in the final numbers. So please have a look at the report for a more thorough explanation of the different aspects that are included in the individual numbers. But as per ESA methodology, we were asked to make individual transition cost estimates per country. So here the comparability is not really given. And the second point that we have witnessed comes from the interviews that we have conducted. And so, for instance, one of the interviewees stated that he or she has he had anticipated the potential of a bidding zone reconfiguration, and therefore kind of already previously, for instance, when I'm not sure, but could be that when Sweden was initially split, there was a dynamic process in place, or they have implemented a dynamic process to be very easily capable to adjust to changes in bidding zones. And if that market participant has responded and we have scaled or had to scale on that databases, whereas Germany, for instance, there's a respondent who has not done that or who has not considered that previously, there may be, of course, some it may show as a strong difference, but essentially it's due to the data availability that we have seen, and it depends on who has in the end responded to the questionnaire. So nodal pricing, we have not considered that.
Would you like to take any of these, Malte?
I can maybe say something about that. I don't think you can conclude from a lack of literature that the costs cannot be, substantial. That would be a conclusion that is very hard. That would be very hard to support. Because you can't rule it out either. But I wouldn't be so brave to draw that conclusion. In terms of the respondents, whether they may have an incentive to estimate the costs one way or another. With the checks that we have been doing, comparing and so on and so forth, we are not able to finally rule that out. Yeah.
But to complement that, we have done checks
Yeah.
for the outliers. So if there has been an individual specific interest, of course, that is noted or then kind of seen in the data. And also we have conducted interviews or selected interviews where we try to better understand how these transition costs have been estimated. But of course, this has not been done with all. So yeah, as stated by Anton, we cannot fully rule that out.
I will just leave the answer as is, and I will mark it as answered. And perhaps we can take we can go beyond a few other questions as well, I believe addressed here on the transition costs. This is on the liquidity, price levels. I believe all of these questions, also given the timing, were posted before, but some of them have likes. Maybe you can address some of these. Let's see if there's any more popular on the top for the transition costs. Perhaps this question has more, these two questions have more likes.
Maybe on the savings. So no, they have not been evaluated as part of the transition costs or transaction cost estimate. For these two studies, we have kind of reduced the analysis to kind of what was considered baser and or what we have stated. So kind of benefits are, but please correct me if I'm wrong. I think such as these are part of other parameters, the biddings on review. And looking to the cost reported by the German TSOs. So as stated again, we have not audited, right? So we have received the costs from the TSOs, and it would be up to the TSOs if they want to shed some more light on that. Yes, but so what we have done is we have kind of considered the differences in costs from different numbers of reconfigurations, and this is also disclosed in the report. But kind of an in-depth explanation of how the TSOs came up with their transition cost estimate has not been assessed by us and has therefore not been disclosed in the report.
But I'm not sure, I mean, TSOs do operate their scheduling areas, okay? But I do not really see in how far that yields you a big advantage with regards to implementing a bidding zone change. It's still first you have one German price, then you have two, or potentially even more. So things for TSOs are going to change when they, and processes will have to change as well when they implement a bidding zone review. Now it's a fair question to ask in how far there could be synergies because of that, because they already have different scheduling, separate, not necessarily different scheduling systems. Yeah, but we didn't delve into that in the course of our study. Let's see what else we have.
I would suggest that we have the last, you can tackle the last two questions. And after we will have a short 5 minutes break. So yeah, I think you can choose based on what you see.
How do you explain that the countries with more experience in previous bidding zone splits, Sweden and Italy, are the ones with the least numbers of answers? Well, I could explain why they would be the ones with the least costs, because they have experience with that already. Well,
maybe
in the end of the day, we don't know why somebody answered or not. Arthur, yeah?
Yes, maybe one aspect to highlight is that when the questionnaires had been published and subject to responses, we have received, or ENTSO-E, oftentimes the kind of statement that there's too much going on. So the energy crisis, if I may, was still quite relevant at that time. So that has been some of the mentions why transition costs or why responses have not been kind of provided. This is kind of the response that we have received, besides the potential complexity of actually making that such an estimate. But this is not only because of for one or another country, but across the board.
And maybe here we can stop, and I would suggest to have the 5-minute break.
Okay.
And that we can resume with the last part, perhaps.
Well, then, thank you very much from our side, from the side of Compass Lexicon. Yeah, it's been a very interesting discussion. Many good questions I see here also on this online tool. We'll do our best to answer all of them. I understand it's a big topic, complicated topic. So we're looking forward to engage further on that. Yeah. Thanks from us.
Thank you.
Thank you very much.
Thank you.
Anton, Malte, Fabian for coming here and answer on live all the questions raised. As we say, we see some interesting questions that should make us think further. As we were saying before, all the questions that has been posed through Slido will be answered on written. So, and in addition to that, what we also want to give you is the feedback that we are really willing to have your answers through the ENTSO-E application on the consultation. Any answer to the public consultation that will not go through the tool, it will not be considered. So we kindly ask you to please follow the questionnaire. I think you have some space for additional points that you would like to raise and answer through it. Having said that, again, big thanks to our Compass Lexicon consultant, Fabian, Anton, Malte. Thank you for being with us. And with this, we give them 5 minutes break. And we will start again. Let me just check what time is it. We can start at, I think we say in the agenda, at 12:15. 12. So we start at 12 with the general questions on the consultation, and also we will try to answer as much as we can the different questions that has been raised and are not directly related to this study. So coffee break till 12:15. So we will start then with the third part of the webinar, which is the public consultation process. The idea of this part of the webinar is, in addition to present how the public consultation would look like, we will also try to answer other questions related to the process. But again, we want to remind, before we get into this part, that the full process of the bidding zone review, including the decision making, is out of the TSO's responsibility. So that's why we need to focus on the parts that are our responsibility, and those are the parts in which we can provide further clarity. Anyway, our idea in this part is to answer to the different questions with the information that we have available, and maybe in the end also open the microphones to allow 2 or 3 online questions from you regarding all the webinar or any specific point you would like to raise. Having said this, I would like to pass the floor to our colleague Martin, who will do the presentation of this part. Martin, the floor is yours.
Yes, thank you, Marta. Good afternoon, everyone. Thanks for staying around so far. Thanks for joining this webinar. I hope we've been able to refresh a little bit in the short break. So we'll start with this final part on how the public consultation is organized. The bidding zone review is actually organized in 2 different regions. So that's the region for the Nordic and the one for Central Europe. However, this consultation covers both of these regions simultaneously. So that means that both stakeholders from both regions can participate. As already was introduced at the start of the webinar, I'll just repeat it just to be sure. The scope of the consultation is basically 4 different parts. It's the 2 different reports that have been presented by our colleagues from Compass Lexicon just now. So that's on the market liquidity and transaction cost, and the report on transition costs. Further on, you can also find questions in the public consultation on measures to mitigate potential negative impacts resulting from a bidding zone split. So we're looking for your input specifically there. What kind of measures could you be thinking of? And do you think these would also influence the conclusions on the 2 reports above? And furthermore, practical implementation considerations. So any practical considerations concerning changing a bidding zone configuration in general, you can also submit through this consultation. So that could be, for example, on the timeline where we have some specific questions. So those are basically the 3 parts that are handled within this public consultation. We also have some further questions which go a little bit beyond the scope of what is prescribed in the methodology at the final part. So there's also some room to give further input to the TSOs there. Based on the responses that we will get in this public consultation, we will make an update of both of the reports, the documents that have been consulted upon. So that are the reports of the liquidity and the transaction costs. And as you can see here on the right-hand side, they have been marked yellow. These are 2 of the indicators out of the total of 22 indicators that we have to evaluate in this bidding zone review. If we go to the next slide, then you can see some practical details around the process. So As always, the consultation is hosted on the website by ENTSO-E. The link is also here down, and we can share it again afterwards. The public consultation was launched at the start of the summer on the 19th of July, so it's been online for a bit more than a month now. And the deadline for responses is the 4th of September. We've extended a little bit at the request of some of our stakeholders. It's covering now a bit over 6 weeks in total. We realized that this is right in the middle of the holiday period, which is inconvenient. That's why we also extended it a bit further. However, this is the maximum that we can do at this stage, also considering that we plan to have a final report with a final recommendation on the bidding zone configurations by the end of this year, so in December. And of course, after getting all the responses, we need enough time also still to be able to incorporate those into the final reports. Like was mentioned already, so this webinar is being recorded, so that will be published on the ENTSO-E website as soon as possible, together with all the answers to the questions that were raised on Slido. I would like to ask you to only provide one answer per representative organization, so coordinate that as much as possible. That would make it a lot easier also for us to be able to handle all the responses. And in the end of the questionnaire, there's also options how you want your answers to be handled. So you can select them to be remained anonymous, or request us not to publish them at all. That's basically in line with the standard terms that we always use for the ENTSO-E consultation tool. So if we go to the next slide, then a little bit on what are the next steps. So like I said, the consultation will be running until the 4th of September, based on all the responses that we get, and which will be evaluated by the TSOs together with Compact Lexicon. We will be able to make an update to both of the reports on liquidity and transaction cost. And based on these two final reports, TSOs will have to assess the performance of the two related indicators. So that's the indicators on market liquidity and transaction cost, and number 11 on the transition costs for each of the alternative configurations. That basically means that for each of those, we will have to conclude if it performs better, equal, or worse compared to the status quo, so to the current bidding zone configuration. This will feed into the final report, like I mentioned, that will be published in December of this year. Responses relating to the practical considerations, so those go beyond the scope of only these two indicators. They will also be used by the TSOs as input to identify any practical considerations that may also play a role in the assessment of all the other indicators. That's basically step 2 of the bidding zone review methodology. That's a very short summary of what the process basically looks like on the public consultation. And I think that means we can already go to the next part, where we handle any questions that you might have in general on the process of the public consultation. And we will try, like Marta already indicated, also to answer some general questions on the bidding zone review, although the focus for today, of course, is really on the public consultation. So these questions will be handled with priority. Georgie, do you already have some questions? Yeah, I'll start actually with the top one. Yep. So how Germany's energy ministry decision to keep the unified bidding zone impact the bidding zone review process? Basically the TSOs have a legal obligation to carry out this bidding zone review and to come up with a recommendation towards the member states at the end of that process. Like I said, that recommendation is expected in December of this year. Based on that recommendation, member states have 6 months to decide on changing the bidding zone configuration. And that process goes a bit beyond the scope of our TSO responsibility. So I would not dive into that further at this stage. So we will have to carry out our legal obligation here. That's to come up with a recommendation. We know from the legislation that afterwards.
So I will then mark it as.
The next question. Let me see. What about member states that have adopted an action plan in accordance with the electricity regulation? Not 100% sure what the question here is, but if I try to relate it to the bidding zone review that's ongoing, I can say that in the simulations we've accounted for the action plan values that apply for those member states. This one today, only 2 out of 22 indicators have been presented. How will the other 20 indicators be taken into account in the bidding zone review process, and where can the progress be followed? Yes, indeed. So we need to study 22 indicators. I just showed you the list briefly on one of the slides. And the way we need to do this is basically prescribed in the bidding zone review methodology. It's a 4-step process. So first we focus on all the welfare impact coming out of the calculations, basically evaluating in terms of welfare if the reconfiguration would perform better compared to the status quo. And in the second step, we evaluate all the other indicators, which might be qualitative. Based on that, we will basically need to assess if an indicator performs better, equal, or worse compared to the current configuration for each of those indicators and for each of the configurations under study. That then feeds into the final recommendation that we need to make at the end of the process. The progress that we make during the whole process is also being discussed with our stakeholders in the consultative group meetings, which we also organize regularly. And you can find more information on that on the ENTSO-E website. And indeed, all the 22 indicators will be incorporated in the final report, including how they've been assessed.
Maybe if I can add on this, I think it's very interesting to take a look at the bidding zone review methodology. Here, the 4 steps are well defined, and that way you will be able to see how we are going to do each of the steps. So the first one is quantitative assessment. This is where we are now. This is based on numbers. Based on that, we will have a list of this welfare regarding the comparison with the current configuration and the alternative configuration, and we will see how this economic result would look like. And this is the first step. The second step, and you can see it here in the middle of the screen, is the assessment of all other criteria. So all criteria that we cannot quantify, we need to assess it. So the 22 indicators, except the ones that we have already considered in step 1, we need to consider it, and we need to see if in comparison with the current configuration, it performs better or worse. Beside other criteria, the liquidity and the transaction cost and the transition cost study will be also part of the assessment that we are doing here. In this step 3, we need to see if there's any configurations that needs to be rejected, and the step 4, consolidation of results and presentation of the final recommendation. All of this is well described in the methodology, So you have the full process there, just as a side note. Maybe, yeah, Margin, we can maybe go back to the questions to see if there's any other very popular questions we can try to answer. And as I said, I think if the technology allows, I would like to at least give the floor to 2 or 3 stakeholders to make their questions live.
Perhaps we could give it live, Marta, and maybe we can address all of these questions because all of them have more or less similar ability, so we can address them afterwards. Or maybe we can give the floor to someone.
Martin, any questions you would like to tackle before we?
Just trying to see if there's anyone related to the consultation specifically or the general process. I think most of them now are on liquidity that are highest rated.
Yes. Yeah.
Maybe just a quick one. There's a technical question. Just, I mean, very easy to answer. That is when it ends at 10 in the morning on the 4th of September. Of course, this is for logistic issues for us. We have, and it helps us to already divide the work that day. So it's, of course, not for anything legal. I mean, legally, we only need to provide 4 weeks for the consultation. It's for our internal organizational purpose. So, shall we open then the floor?
Yes,
I don't know.
I was just saying.
Is it possible to?
Yes, I have just allowed the mic
hands?
to the. Yes, I have allowed the mics to the attendees, and whoever raises the hand, I believe we can give them the floor.
So this is your opportunity. If you have any question you would like to raise, I see a hand from Stefan.
Yes,
Please,
hello,
Stefan, go ahead.
It's from Westnetz, Germany, part of E.ON, so DSO. So thanks first for the very detailed the presentation of the study and the results. More organizational question. Is it possible to have the questions of the questionnaires upfront as PDF to make up my mind or what might be the answer? I think it's more comfortable than going through the survey and then making up the mind what should I answer. In particular, as we want to discuss with the other EN DSOs about our answers. So is it possible to get it?
Yeah, that's no problem. We can make that available in PDF. We're supporting it together with the other materials resulting from this webinar, so the recording and the written answers to the questions that have been raised.
Very good. Thanks a lot.
Richard?
I'm not completely representing an association. I am, as many know, quite involved in Europex, so in that context indirectly. But I just wanted to ask again the question that I posed twice about, I mean, all fair and good and important with the costs, but cost-benefit analysis typically also evaluates the benefits. And I saw actually now that there was some in this timeline, something about benefits or something, but is there not any sort of study, inquiry or evaluation? And I don't mean to say benefits only for any reconfigurations, but obviously any reconfigurations versus the status quo, because in various cases, either one or the other can have substantive benefits. Question then is any of that going to be conducted? And is it going to be shared and potentially at least in a webinar discussed with market stakeholders? Because I think it's a bit one-sided to focus only on sort of the cost aspects. Yeah, so that was my question.
Yes, for all of these 22 indicators, basically we need to assess whether they perform better, equal, or worse, or also better. So for each of them, we can conclude that there are actually benefits from the reconfiguration. And the first indicator that has the most weight in the process is in step 1, so the socioeconomic welfare. So there, for example, it could be concluded that on a European level, a reconfiguration performs better than the status quo in our simulations. So that's definitely part of the scope of the total bidding zone review program.
Maybe just to complement that, there's not any public consultation expected on all of these other indicators. Of course, they will be described and analysis will be presented when provided the final bidding zone review. But there's not any public consultation expected. We will see how far we are to be able to share some results informally. For sure, we want to share as much as possible with the consultative group, but it will not be a formal process. Any other question you would like to raise? I do not see any hand. I don't know if I'm... I see one. Robert?
There is a hand raised by Robert.
Yeah, it's Robert Gerstl from EX. Thank you. I also posted a question in Slido. It's a question related to the consultation. You are asking a question on mitigation measures. However, for me, mitigation measures is missing in the reports. I have not seen it or overread it, but I haven't recognized that there is something in it, and it was also not mentioned in the presentation by Compass Lexicon. So the question is this part of the methodology? Or the question is, why are you asking for this? So is it part of the methodology? And then the question is, if yes, why it's not in the report? And if it's not in a part of the methodology, why are you asking for it? So I'm asking myself, what will you do with the answers of this question? So I have doubts that it will be reasonable and objective enough then to put it into your conclusion. So can you say something more or elaborate more on this?
Yes, you are correct indeed. Mitigation measures have not been discussed in both of the reports that have been published for this public consultation. However, they will be considered in the final versions of this report. And that is exactly why we're asking now the stakeholders to provide feedback on that so that we can incorporate it there. So this is indeed also part of the requirements that results from the methodology. So the analysis that have now been shared are purely based on basically the status quo. So how would liquidity and how would transition costs develop given the current market setup?
Is it clear, the answer? I think it's clear. Your input in the public consultation, the public consultation will be the input for our final report on this specific topic.
Yes, the answer is clear. However, the question is whether this is then the answers are reasonable to to be used. Yeah. So I mean, otherwise you conduct a study and with a literature review and so on and so forth. Yeah. So the answers are then somehow valid. I mean, here the answers can be random. Yeah. And then the question is the quality high enough to use this in your recommendations and your final report?
Yeah, I think we will have to assess this with the answers, and of course the TSOs also have some knowledge and will share their knowledge on this. But just to assure you that the idea is to consider the input that you are provided in the public consultation in the final report regarding this question. There's another hand. I would suggest that this will be the last one then. Lars?
I have a question about the income of the rent income for the TSOs between, let's say, a market split. How does I understand that we have establishment costs and maybe also ongoing costs to have multiple bidding zones. But the rent income, I cannot see where it has been stated how this rent income would feed back to the TSOs and could alleviate, say, some of the potential costs in otherwise expanding the grid if we would not have a bidding zone split.
Yes, thanks for the question. Indeed, it has not been discussed today because the focus for today is mainly on the transition cost and the liquidity report. However, as one of the indicators in the total bidding zone review, we're evaluating the socio-economic welfare effects. And these are basically composed of the producer surplus, the consumer surplus, the congestion rents, so that's the one you're currently referring to, and the changes in redispatch cost. And these together make up for the socio-economic welfare, which is, like I said, one of the most important indicators that will be used for reaching the final conclusions. So it's definitely part of the study, and it's captured in this case under indicator for the socio-economic welfare effects.
Thank you.
You're welcome.
So then with this final question, I would suggest that we move to the conclusive remarks. First of all, we just want to give you a very short timeline to explain that as you can see now in the screen, the public consultation will go till the 4th of September. After we gather all the answers on the public consultation, we will incorporate them on the final report. And the idea is that the final report of the bidding zone review, including the recommendation, will be ready by the end of the year, so by December 2024, for both regions, Central Europe and the Nordic region. Of course, once we will have the recommendation and the final report, we will organize another webinar. So we will be able to further go into all the different details. Not at this one that was mainly focused on these two criteria, the final report and the final recommendation should tackle all the different aspects of the bidding zone review. The slides that we have shared today, they will be available in the website, the same as the recording of this webinar. We will also include the PDF, as was requested here, of the public consultation. It will be also included there. Please submit your answers till the 4th of September in the morning. I think that's mainly all we wanted to share with you today. We know there was a lot of information, very detailed information on the two studies. Once more, we want to thank our Compass Lexicon for participating and try to answer all the questions. All the questions that has been posted in Slido today, we are working now already to provide also written feedback to them. So I think there will be also published in the website once they are ready. And having said that, we just want to thank you for being here in the middle of August. And we hope that we were able to answer at least some of the questions that you may have related to this public consultation, and that we are able to receive your input by the 4th of September. Thank you very much, and have a good end of the summer.